Hello everyone, it's Yusri Ahmed with you. Welcome to our first interesting lecture. In today's lecture, we will start with what we mean by corporate finance. Second, what are the main goals and rules of financial management? Simply, if you would like to work as a financial manager, what will be your job description? And finally, what do you mean by financial markets? Generally speaking, finance is a very easy discipline because you can use simple real-world example to explain its concepts, and this will be my teaching style during the lecture. So we can understand the definition of corporate finance by raising a simple practical question of how to start a business. Please bring a pen and a piece of paper and think on a business that you may interested to start. For example, can we choose cafe? Then think about what kind of staff you need in order to start your business. Please stop the video now and then play it later. Hi, welcome back. So, in order to start your cafe, you will need some stuff such as a shop, some tables, some seats, machinery. Okay, brilliant. In language of finance, we call those stuff as assets. Okay, the second part of our interesting question is from where you can raise money to buy those assets. Just think about it. You need to start a business and you need money. From where you can get the money. Brilliant, well done. Yeah, you can borrow. So the first source can be borrowing. In language of finance, we call it total liabilities. Okay, what else? Is there any other source of finance you may use? Yes, you can use your own money or you find another investor. So using your own money, we call it as owner's equity. If you look to this equation, it's a familiar one. It's the equation of the balance sheet or statement of financial positions that you have at accounting courses. So the statement of financial position is a simple equation of how to start your business. Generally speaking, you need some assets, and from where you can buy those assets. What are the source of finance? We have two sources. We have external source of finance, which is borrowing, and we have some internal source of finance, which is using your own money. Does it make sense? Well done, guys. Okay, let's go back to our main slides. I wrote here actually the same kind of information. If, for example, you would like to start a company that will produce tennis ball, so you would like to have investment in assets such as inventory, machinery, land, and labor. And the second question, usually from where you can raise money, we agree that we have two sources. We have internal source of finance, which is your own money, or external source of finance if you're gonna borrow money. Okay. When you begin to sell tennis balls, your firm will generate ask a very interesting question. Why you invest your money? Why you don't simply use the money to buy some stuff? Because you would like to have more return. So in any business, your main objective is to maximize your own money. Does it make sense? Well done, guys. Okay, you're gonna watch a video about Companies House. Companies House actually is a web page that can help you to start a business in the UK. Here, some information that how to start a company, and also I will play a video right now that will give you a very quick information of how you can do this. You will also find on Canvas a detailed video on how to start a business on Companies House. It's around 15 minutes. I highly recommend all of you to watch it in order to grasp more practical information on how to apply our concept into practice. So, generally speaking, corporate finance, we have two sources of finance. As we mentioned in our cafe example, we have borrowing, and sometimes we call it debt. You borrow money from somewhere, from bondholders or from the bank, or you can use your own money, and we call it share. So the next interesting question is simply, it's a random decision to determine the percentage of required capital that will be raised using debt or shares or equities. In another way, in order to start your cafe, you need 10,000. My question here, is it a random decision how much you will borrow and how much you will use from your own money? Will you borrow 50% of the required capital or 70%? Will you finance the entire project with your own money? So in order to answer this question, we need to understand what is the pros and cons of each financial tools. What is the advantage of using debt and disadvantage of it as well? What is the advantage and disadvantage of using? So let's just start with equity or shares. What does this mean? Let's use a very simple example. For your cafe, if you would like to start a cafe and the required capital to buy the assets is 10,000 and you have only 5,000. Assume that your credit score is very low, to the extent you are not allowed to borrow money from the bank. In this case, from where you can get the rest 5,000. So you have only 5,000, you need 10,000 at the end of the day. Think about it, please. Brilliant, well done. You can find another investor. You can ask your family member, can anyone or whether anyone is interested to join you in the cafe. If you find someone who can pay 5,000, this means that the new partner share 50% of the ownership of your company. You paid 5,000 and another investor paid 5,000. So both of you share 50% of the ownership of the cafe. And this is from where the word share comes from. Okay. I can also argue that shares is one of the greatest inventions in finance as a science. But why I say that? Simply, let me apply the cafe example on large scale. For example, for a big corporation or any company, if you would like to start a manufacturing company, for example, you may need 10 million. The question here, will be easy for you to find someone, to find another partner, another investor who has 10 million and is willing to give you this 10 million? I assume the answer would be no. Okay. But if you can find someone who has this 10 million, and in order to convince him or her to give you this huge amount of money, you should offer him a very, very high return, to the extent that your company may not be able to pay back this high return. So it will be very difficult for anyone to start a big company. Here, our finance scholars intervene and introduce a very smart idea of shares. Rather than asking someone to give you 10 million, let's divide the ownership into 1 million share each for £10. So rather than asking an investor to give you 10 million, no, you will ask someone to give you only £10. Just feel the difference. So even now in your level, you can easily find some family members, some friends who are willing to give you £10 to join your idea, your own project. Thus, the general idea of having shares is simply to divide the ownership of a company into affordable share, £10 rather than 10 million. So you will be ready to give this £10 and you wouldn't ask for higher return. And in the worst case scenario, if something goes wrong, you will lose only the £10, the shares price. Okay, so we have here as shareholders. What do you mean by shareholders? They are the owners of the company. If you buy a share in a company, you will be invited to a shareholders meeting in which you're gonna elect the board of the directors. Simply, the board of the directors will recruit and select the managers of the company. And we have also here dividends. Dividends represent the return, the profit that you will get from the company. According to the mechanism of shares, you will only get dividends if first the company generates profit, second the management decide to distribute those profit on the shareholders. Let's move to the second source of finance, which is debt or borrowing. It's a legal contract. So generally speaking, when you borrow from the bank, you sign a contract that you have to pay back the principal and the interest rate of borrowing. So whether your company, your cafe is doing very well and you generate profit or not, you have to pay back the interest rate and the principal. Okay, also it's collateral. What does this mean? Collaterals mean it's secured by an asset. In most cases, your loan will be secured by an asset. For example, if it's a car finance, if you can't pay back your interest rate, the bank will take over the car and sell it. If it's a mortgage, the bank may take your house if you failed to pay back the interest rate. Okay, another features of debt is tax shield or tax saving. What does this mean? One of the advantage of raising money using debt and it offers tax saving. So let me share a simple example of you in order to explain what do you mean by tax shield. Consider we have two companies, A and B. Both companies have raised 1 million. So the capital that being raised is 1 million. Company A sold bonds yielding 8%. The interest rate of using bond is 8%. For company B sold ordinary shares offering a dividends yield of 8%. So both of the companies have the same cost of capital. So both of them raise 1 million. One from using bond, which means that they borrow at interest rate of 8%. The other one through using shares or finding another investor and they offer them return of 8%. So both will pay the same cost of capital. Okay. Let's assume that company A here used 100% debt finance, company B used 100% equity finance. Let's assume that the profit the post company generated is the same, 200,000. What do you mean by profit? Simply your sales minus your cost. Company A will pay interest equal to 8%. So 8% is £80,000 because company A used 100% debt finance, but company B doesn't have any interest rate to pay or interest payable to pay. So now the amount of profit left that will be taxed is for company A is 120,000, for company B 200,000. Let's now apply the tax. If the tax rate is 30%, this means that company A will pay 120 times 30%, which is 36,000. On the other hand, company B will pay £60,000. Okay, now the dividends should be paid. Company A has no dividends because it used only debt finance, so it will be zero. For company B, it has 100% equity finance, so it will pay £80,000 as dividends. Now the net income left for company A is 84,000, for company B is 60,000. Okay, from where the difference comes from? So both company generates the same profit and they pay the same cost of raising money. Company A paid 80,000 as the cost of borrowing. Company B paid 80% as dividends as the cost of using another investors. But at the end of the day, company A has net profit equal to 84,000 and the company B only 60,000. So the difference is 24,000. Company A being able to generate above company B. From where this figure comes from? If you look to the amount of tax each company paid, company A paid only 36, while company B paid 60,000. So the difference is 24,000. Because the bond or loan, usually you pay the interest on them before you pay the tax, which means you have tax shield or tax saving. The difference is £24,000. Represent what? Represent contribution from the tax scheme toward your debt. Does it make sense? So one of the advantages of borrowing money or having debt that you will pay less tax. You will have tax saving. Okay? Let's get back to our slide again. So the advantage of debt, it's legal contract, so you must pay back the interest rate. It also offers an attractive tax saving for the borrowers. And finally, the risk. Which one is more risky? Compare debt and equity. For debt, what is the risk of the bond holder or the debt holder? In another word, what is the risk for the bank? It's a minimum risk. Why? Because the bank has both its collateral, the bank has a security or an asset that can take over in case of failure to pay back the interest rate. Also, it's a legal contract. Whether your cafe is doing very well and generate profit or doing very bad, you have to pay back the interest rate. And if you can't, they will take over the cafe. If it's not enough to sell the cafe, they will take over your personal wealth, your personal money. On the other hand, shares, the only case as a shareholders you will earn a return only if the company generate profit, and it does make sense. If your company generate loss, as an owner you wouldn't take any dividends. So After explaining the advantages and disadvantages of the two sources of finance, equity and debt, let me ask a very interesting question now. Let's assume that we have two companies, A and B, both have the same capital, the same value. Company A raises its capital using 50% debt and 50% equity. This is the capital structure of Company A. Capital structure means the mix of debt and equity the company used to raise the required capital to start the business. Company B has a capital structure of 75% shares and 25% debt. Please try to answer which company is more risky than the other, especially in case of break-even. Break-even is simply when your sales equal your cost, so you don't have any profit. Which company will enjoy more tax shield than the other one, and which company may face more financial constraints? Please answer those questions. Which company is more risky, A and B? Well done. Company A is more risky, but why? Because company A has more debt than company B, which means that company A will pay higher interest rate. It has more interest payable relative to company B. For the tax shield, which company will have more tax saving? Brilliant. Company A in this case, because as we explained in our previous example, tax shield is related to bond. Okay, financial constraint. What do you mean by this? Financial constraint is simply the ability of the company to raise money from the external market. So let me share a simple example with you. If you already have a car finance and you have a student loan, is it easy for you to have a loan to buy a house, for example? No, because you already have lots of loans, so your chance to get extra money from the bank will be very low. Let's apply the same example on corporation. Company A has half of its capital raised from debt. So if the company wanted to borrow more, it will be very difficult and it will cost the company more money. Usually the bank will consider this company as a risky company and it will require the company to pay higher interest rate than company B, which will have more advantage to raise money from. So please watch this interesting video of why did Thomas Cook collapse. One of the main reasons is related to debt, that the company can't pay back its debt, so that's why the company has failed. This is a practical example of how debt may lead to debt. And this is related to our question whether capital structure is a random decision. The answer is no. You have to make a balance, a trade-off between the advantage and disadvantage of each source of finance.